So this isn't a popular opinion, Bill. You believe that this financial euphoria episode, if you will, could permanently damage investors' long-term success. Why?
Well, first, even my friends are avoiding me right now. So the first thing to understand, there's like a three-part facet to all this. The one you mentioned already is that no one at Amazon and no one at Netflix considers themselves a consumer company. They all think they work at a tech company. So if you add Amazon and Netflix into the tech component of the S&P 500, it is now 30% of the S&P 500 index. And 30% is where it peaked out at the end of 1999, just to give you some flavor. The second thing is the valuations of a lot of these things from a historical perspective show you that it's very maniacal. Lately, if you watch your show for 2 or 3 days in a row, I'd love to get $5 every time somebody tells you about the total addressable market in groceries or the total addressable market in the pharmacy business. And so what that means is people are putting a lot of capital behind the potential. In a story you folks just ran, you talked about trying to get a big percentage of the grocery delivery. Well, grocery delivery is only about 2% of the groceries purchased in the United States of America. So if you just explode and triple that over the course of the next 5 years, you're going all the way to 6% of the business, and no one has proven an ability to make money. So it's a combination of a mania in terms of price-earnings ratios and popularity. It's a mania in concentration. And then the third thing is these are monopolies. We're dealing with 3 or 4 or 5 major monopolistic companies, and it would be remarkable from a historical standpoint if the United States government is willing to cede control of the United States of America to a for-profit business.
Tech accounts for about 25% of the S&P 500 right now. It is certainly much more than it's accounted for in the last 18 years, but it's nothing compared to dot-com bubble days. Would you say we are in dot-com bubble territory?
History never repeats itself, but it rhymes. And you have to hear the rhymes. I'll give you an example. In the dot-com bubble, we had eToys with a $10 billion market cap, $50 million in revenue, and a $40 million loss. It's not that kind of nutty. It's not an IPO coming out every single day for a year that doubles the first day and being a financial advisor and all your neighbors think there's something wrong with you because you're not getting them shares of those new IPOs. That's not what this is. What this is, if you own the entire Netflix corporation so far this year through the first half of the year, you would have had to write checks for about $2.8 billion because that's what their negative free cash flow is. And the last time I checked, the purpose of owning a business is generating positive free cash flow. In other words, there's some money the business made that you could use to your own benefit at the end of the year. So again, it's a different kind of mania. This is a mega large cap mania. It's not an IPO mania like what we saw back in '99.
Now, I have another chart in my GTV library that shows Facebook, Google, and Apple actually lagging behind Netflix and Amazon when it comes to year-to-date gains. We also see Amazon vying for that $1 trillion market cap, perhaps arriving there even before Apple. Do you think any one of these companies is better off than the others?
Well, it's certainly a bird in the hand is worth 2 in the bush. So Apple has already found over many, many, many years an ability to make billions and billions and billions and billions of dollars. So it's a highly profitable business with massive free cash flow. You know, if anyone wanted to pick on us as portfolio managers at Smead Capital, that would be the one they want to pick on us about not owning, because it fits a lot of the parameters that we look for in a common stock. But I don't spend very many sleepless nights worrying about whether I should have owned a stock trading at 150 times earnings, because the 5 5 to 10 year success of the stock price of a company that trades 150 times earnings is so terrible from a mathematical probability standpoint that it would be effectively a suicide mission from a historical perspective. And it might be different this time, but those are the 5 most damning words in investing.
If a correction is indeed coming, Bill, when is it coming? We thought perhaps with the data scandals and the controversy surrounding Facebook and Cambridge Analytica that would see the beginning of some sort of correction. There was a lot of tech volatility earlier in the year, and it has all, in essence, disappeared. We saw very strong earnings from Alphabet this week. If the bottom is going to fall out, when? Well,
first of all, that's one of the great challenges of ignorance avoidance, right? We try to practice ignorance avoidance. We have 8 criteria for common stock selection, so we pick the stocks we buy by companies that fit our 8 criteria and are available at bargain prices. But on the other hand, we try to avoid getting caught up in popular manias, and that's what this applies to. So the answer to your question is a really strong positive market dies because it runs out of buyers, not because some horrendous bad news comes along and causes a whole bunch of sellers to show up. You die at the top because you get to the last buyer. By the way, margin balances are at absolutely legendary level absolute numbers in the United States right now. People are borrowing money to buy stock, and people are trading at discount brokers up 50% year to year. Obviously, a lot of people are trading these very successful momentum stocks. And so at the bottom of a market, you get to the last seller, right? Margin calls happen at the bottom. Somebody that would actually like to buy the stock is forced to sell. And what happens at the top is the short sellers get squeezed, and the last buyer is when the shorts clear their positions out. So I tell people you can't hold your breath till this is over. And then they ask me about Amazon as an example because we're here in Seattle. I have no idea where that stock's going to peak. It could peak at $3,000 a share. But where it ends up when it does correct after that is probably not going to be a lot different regardless of where it peaks. In other words, if it peaks at 2,000, it'll bottom at a dramatically lower price. If it peaks at 2,500, it'll probably bottom at that same price it would have even if it hadn't gone up to there. Because on the way up, you go up on an escalator, and on the way down, you go down on an elevator.